Okay, good morning and welcome to Saxo's weekly market outlook call once again. It's called Saxo Spotlight. Today is Monday, April 10th, 2023, and we hope Q1 has been great for everyone. It's certainly time to tighten your seatbelts because the macroeconomic outlook continues to get very complicated from here. I'm Charu Chanana. I'm a market strategist at Saxo Singapore. And my colleagues in Hong Kong and Sydney still are enjoying their Easter break. So you will have to bear with my long monologue today. Thankfully, I have some slides for you to look at. Let me just share that now. Yeah, okay, I guess you can see my screen now. So just starting off with a very quick summary of the markets last week. It was a holiday shortened week for most asset classes, were closed on Friday for Good Friday. But equities still closed with positive gains there because primarily banking concerns remained at bay. There was no more, there were no more shocks on that front. And then there were also some signs last week of a cooling US jobs market from, higher than expected jobless claims data or also a drop in job openings earlier in the week. And then we also had some weakness in ISM services as well. All of that kind of combined continued to signal that Fed tightening could end soon, and that obviously helped the equity markets. But Friday, when equity markets were actually closed in the US, we had the non-farm payroll data out, which is a key indicator of the US labor markets. So I've just summarized the top numbers there. Headline job change was higher than expected, 236K, and last month's was also revised higher to 326K. However, this was still the lowest monthly increase in 27 months. And if you look at private payrolls, they kind of missed expectations. So a lot of this job gains has been driven by government jobs. But overall, the report was quite mixed. We had the unemployment rate still down to 3.5% from 3.6% in February. Wage data higher month on month, but the year on year trend still continued to show a softening. So with that, overall data kind of still remaining mixed. I think the bigger conclusion for me really was that it's not soft enough for the Fed to really pause rate hikes for now. I mean, if we do see the bottom chart here on the slide, also the rate hike odds for May have soared to about 70% after this NFP release on Friday, from just about 50% earlier. So markets are now again expecting a 25 basis points rate hike from the Fed in May. So that I think just the fact that every single data point about the US economy, and especially more so now about the labor market, is keeping the Fed expectations so fluid. We are seeing such big shifts in those expectations. So I think that's really the key message as well here. And we are going into this week with an eye on inflation data, the US CPI, which is out on Wednesday. So what to expect there? Again, my sense is that disinflation has to continue, but it has to continue in a very noticeable way to support the current Fed pricing, which, in my opinion, is slightly more on the dovish side, with peak rate not even like 5% again now, from what it was above for 5.5% before the banking turmoil really began. So if the CPI number is not soft enough for the markets to believe that the inflation fight is over, then we can see these expectations for the Fed path from here being revised higher again, because again, banking worries are have taken a bit of a backseat for now. So the consensus expectation for CPI is for a slowdown from February's 6% levels. So that wouldn't be a surprise. Inflation really, I think, needs to kind of cool more significantly than that. And the disinflation has to also come from the services side, which has been really driving inflation in the last few months in the US, right? So, if we do see some more concrete signs of disinflation in goods and some signs of a beginning of disinflation in services, I think that will be really needed for the markets to continue to price in a pause, maybe even in May or even after that. I think otherwise there's a potential for some of the Fed rate hikes to come back in the pricing for the Fed futures. And then, of course, now we have the OPEC plus production cuts as well last week, and that has also raised the inflation risks. I mean, of course, we won't be able to see it. The cuts only begin in May, so we only see the impact of that coming through in the second half of the year. But what I'm trying to say here is that the slowdown in the CPI has to be really marked to get over with those inflation fears, and I really doubt we're there yet. So I think that will be key to watch this week. And as you can see here on the slide, there's also a host of other data to watch in the US this week. FOMC minutes out on Wednesday as well, which will be key to interpret what officials made of the banking crisis and what they're thinking in terms of the policy response to such risks going forward from here. We again have jobless claims, and then we have retail sales for March as well, which will again form an assessment of the recession risks, which certainly are becoming more pronounced. But I think the bigger focus for that will be on banking sector earnings, which are actually kicking off the Q1 reporting season this week. So on Friday, we have several US banks reporting Q1 earnings, and that's not just important from an earnings perspective, but also because of again, all the banking sector concerns that have been around lately. So focus will be on any commentary around deposit levels, how that is being affected after the collapse of the Silicon Valley Bank. We also actually have one of the regional banks reporting as well, the PNC Financial, that you can see on Friday, along with, of course, the global banks, JP Morgan, Citi, Wells Fargo, BlackRock. So key to see whether deposit flight is taking place from regional banks to bigger banks or even to money market funds. So, is it taking place across the sector, and even the bigger banks are reporting deposit flight, or they're reporting more incoming deposits than outgoing? What banks really say about risk management from here, because, of course, risks are going higher as Fed continues to tighten. So how do they respond to that? And also, I think the other key aspect will be their exposure to commercial real estate. That really is potentially, we're looking at it as the next shoe to drop, because stress on the real estate side can also mean a lot more further pressure on the banks. So what are the kind of exposures for the different banks to commercial real estate? I think that will also be key to kind of understand from this earnings season. Moving along, I'd also like to just touch upon the Singapore monetary policy today, as we have a decision due from the Monetary Authority this week. I think it's really hard to get a conviction for this decision. But given how high inflation is, we still have inflation running at about 6% in Singapore. And given that financial concerns haven't really taken a turn for the worse, or haven't really drilled down into Asia, I think Asian banking sector, Asian credit has been far more resilient, despite all the banking worries that we've seen in the US and Europe in the last few weeks. So that does suggest to me that the MAS could potentially squeeze in some more tightening for now. Labor market is also still quite tight. House prices, rental prices still uncomfortably high. And as many of you know, I'm showing on this chart as well here, Singapore monetary policy isn't about setting interest rate. It rather actually sets a band for the Singapore dollar to trade in. And for now, the currency is potentially trading close to the upper limit of that band. The band is between those orange and the pink lines there. So we are touching the upper limit of the band. So I think, again, that does mean that we could see this band shifting higher. It could be via the recentering of the midpoint of the band, or there are other tools that they use as well. They change the slope of the band or something. So, but again, my sense is that before economic concerns become bigger than what they really are, as we start to see a slowdown in the West, which potentially will have some impact, at least on the small open economy of Singapore, all the trade-dependent economies of Asia as well, more likely than the domestic demand-driven economies of, say, India or Indonesia. So before those concerns really become big, I think there is still some time for some of the central banks to squeeze in a little bit more of an inflation fight there. I think just as we talk about Singapore, I think no discussion on Singapore markets is ever complete without a mention on REITs. So I think that's also very important. We had a strong performance in Q1. Question is obviously whether that can be repeated in Q2 or not by S-REITs. So historically, what we've seen is that share prices of Singapore REITs have performed well following a pause in the Fed's hiking cycle. But the macro environment, like I started off with this call with also saying that the macro environment is pretty tough at the moment. There is obviously rising inflation concerns, and there is obviously a chance that the Fed will pause soon. But there are also still inflation concerns on the table. So I think it will be prudent to be selective here if you want to find some opportunities in the REITs. And a lot of investors are actually playing that defensive REITs play, and a lot of them are also shifting from banks to REITs. Although again, Singapore banks are relatively far more safer than again compared to the concerns that we've seen in US and in the West, but there is some bit of that shift happening from banks to REITs. So there are tactical opportunities in that space. And there's also a tactical opportunity with the China reopening. So anything with exposure to China could potentially do well. But again, it's short term. In the medium to long term, we would still be cautious of exposures to China. So just summarizing here, especially for our equity traders, here's a quick look at the performance across Saxo's equity theme baskets year to date. And I think semiconductors has really been the best performers so far this year. With all the political capital that's going there, potentially that looks like there's more opportunity there due to the decoupling that's happening between the US and China. China reopening is also still a key theme. You can see that here in the luxury basket and the travel basket outperforming. On that note, I think we also have an APAC travel basket. So that's not included in this table here, but you can look into that on our platform and see if there's, you can look there for some stock inspirations as well in the region if you want exposure to the China reopening theme as well. And then we have defense, logistics also doing well. And I think these are our top picks for this year, given the geopolitics that is there and the fragmentation of the global economy that is happening. And I'll touch upon that a little bit later as well. And just shifting gears again to briefly to FX and to commodities, I continue to be surprised by sterling's strength, I would say. So I think that will be again a big focus for me this week. And the other key, I think conclusion that I see from this FX chart particularly is the Kiwi strength that has been far more limited despite the 50 basis points rate hike from the RBNZ last week. So it gives me a sense that market continues to believe maybe that RBNZ will have to pause soon. So there are again potentially some tactical opportunities there after Kiwis gained a massive 11% plus kind of gains against the US dollar in the last 6 months. The Japanese yen as well. We now have a new Bank of Japan chief taking over this week, and the April Bank of Japan meeting will be highly watched. To understand his policy stance. Although we've got a hint that he still focuses on policy continuity, but he's still also open to some tweaks in the monetary policy, at least to respond to market pressure. So how he goes about doing that, or what is his view on the economy, on the global economy, I think that will be really important to watch. So expect volatility to continue there, I think, especially if you see US inflation fears also coming back with the CPI report on Friday. Like I said, there's a massive potential for the Fed repricing to happen in the markets, and that obviously is a key driver for the Japanese yen as well. So I think that's where my key focus is in the FX space this week. And over to the commodities side, of course, oil market has been a big focus last week after that surprise production cut announcement from OPEC plus. Now, big question is whether that upside we saw in oil prices, I think it was about 8% gains, can it stick or not? So the decision from the OPEC was somewhat a way to attack short sellers as well. So it did drive some of the short sellers out of the energy markets, I would think. And from here on, I think there could be a lot more focus on market fundamentals. And what that would mean is the supply side and the demand side. So we do have monthly reports from OPEC and IEA coming out this week, which will shed more light on the supply side. But I think for the short term, I do see that, potentially there are ample supplies, and the focus is again on how much of a slowdown can we see in demand or global growth outlook. For now, oil demand weakness from the West is being more than offset by demand growth from Asia, mostly from China and from India. But whether that can continue or not, how deep the recession is, and how quickly it comes, and that will be the key driver of oil demand and oil prices in the near term. So I think a lot of factors to watch there as well. And the other key commodity, I think, still will be gold. It touched highs of $2,030 last week, and but is back around the key 2000 level again this morning in Asia. But I think the big driver there is the U.S. yields, which have been dropping quite fast. And if that continues, if recession fears continue to pick up, given what kind of a data we see out of the U.S. this week, I think gold could potentially, move further towards that record highs of 2075, in the next few weeks to months. So I think that's important to keep on your radars. And I think that's just a wrap here. I've already touched upon all the US data that's due. There's some key data coming out of China too. Credit data, inflation, trade data as well. But I think more important to watch there will be the geopolitics, as China is conducting again military drills around Taiwan after the island's president returned from a visit to the US. So very similar to what happened in August after Pelosi's visit to Taiwan as well. So how further it goes from here, I think that will be really important to kind of set the risk sentiment tone as well, and especially because we still have thin liquidity. Some of the markets are still closed for Easter this morning in Asia. So I think the geopolitical situation is really key to consider. And then the Singapore MAS decision will be key as discussed. Commodities, we are watching gold and silver, but more importantly, do the oil price gains that we saw after the OPEC cut manage to stick, or do demand concerns take charge and overpower kind of any minor supply issues? That's it for me today. But before I close, like I said, we know how tough the macro environment is right now. So the Saxo strategy team has actually launched the Q2 quarterly outlook last week. The outlook really talks about the short-term, medium-term, and the long-term impacts from the banking crisis. But we also look at the broader theme of fragmentation playing out, which is extremely important to consider in your portfolios, I would think, especially if you're an investor. And to find out more on this, we have a range of events scheduled around it. So we hope to see you there. For folks in Singapore, we have a roundtable for our VIP clients this week. And then we also have a webinar which is open to attend for everyone. It's on Thursday at 12 p.m. Singapore time. You can register for that on our platform. Here's a quick snapshot of the details of the webinar. And that's it for me today. And do not hesitate to reach out to us at Saxo if you need any assistance with your trading or investing journeys. Have a good day, good week, everyone. Bye.